How are you? It's Leah Cross with the Mortgage Center, and I wanted to get back to basics for you and help to explain for those of you out there who don't know, or you're a first-time home buyer, or you're just kind of faking it this whole time that you know what you're talking about, but you really don't. Here's a video you can watch in the privacy of your own home to find out what exactly is fixed rates and what exactly is a variable rate. They're used very commonly, thrown around, but it's come to my attention and my partner's attention that not everyone knows what that is. And case in point is my partner was asked if he could get her the best rate on a fixed variable. That's two completely different things. So I thought I would do this video to help you understand what these terms are that I just throw around on a casual basis. So, fixed rates. How this works is typically you're going to lock in for a term. Now this isn't to be confused with amortization. Amortization is something like 25 to 35 years typically, and that's basically how long it'll take to pay off your mortgage. But what you do is you sign up to a specific lender who's going to loan you the money for the mortgage, and you sign up with them in terms. So like a chunk, say 5 years with this lender, and then at the end of that 5 years you're going to move to another lender, and then at that 5 years, you know, do that for 25 years until your mortgage is paid off, or however you end up working it. So with a fixed rate, you're going to choose your term. And depending on how long of a term you choose will dictate your rate. So commonly, you know, there's the 1-year terms, 2-year, 3-year, 4-year, 5-year, 7-year, 10-year terms, even 15-year terms. Now typically when people say what's your best rate, typically what people are quoting you is a 5-year term. That's just kind of the go-to average consumer product that they'll use is a 5-year fixed rate. With a 5-year fixed, that's basically saying that for 5 years you have to stay with that lender. If you decide that after 3 years you're selling the house and you're moving to Cuba, or you're going to refinance because you want to pull money out from your home to use for renovations, if you decide at some point mid-term that you want to get out, there's going to be a penalty. What are these penalties? Check out my other videos. I won't get into that on this video. But that's what a fixed is. Now why would you go with a fixed? It sounds like it's really restrictive. Well, the safety is in the rate lock. So you may have also heard that rates go up and down, and oh my gosh, rates are going up, and oh geez, they're dropping now. A lot of people can't deal with that. It stresses them out. So what they want to do is go look at what am I going to be paying for the next 5 years. I want a rate, and I want it locked in, and I don't want to have to think about it ever again until 5 years. Well, go with a fixed rate. So that's what it is. It's basically safety in rates, safety for what your payment's going to be. Every month is going to be the same unless you decide to pay more because you want to pay down principal faster. Alright? So that is a fixed. What is a variable? Well, a variable, typically you're getting them, unless it's a variable open, which simply is a whole other video. I'll talk about open and closed, but variable open just means you can get out of that mortgage at any point. But if you go with a variable closed, which is, again, the go-to variable, that means with most lenders, it's only recently that there's about 3 lenders that offer a 3-year variable, but for the most part, all of them are 5-year variables. What does that mean? It sounds just as restrictive. Well, a variable moves on a different economical platform than fixed. Fixed kind of moves with bonds and stocks and things like that, but prime moves based on whatever the government wants to set it at. When someone says, give me your best variable rate, I won't actually give you a rate. What I will give you is a discount, and it'll always be based on prime. So for example, today you could get prime minus 0.65. What happens there is because prime is fluctuating, not constantly, but it does fluctuate a few times a year. If prime goes up, you maintain your discount amount, but your rate's going to go up. See what I mean? So to make it easy, say it was prime minus 0.5 and prime was at 2%, you'd be paying 1.5%. But if all of a sudden prime went up to 3%, now you're paying 2.5%. Maintaining that discount, but it is moving with prime. That's what variable is, and that can stress people out sometimes. So again, you may say, why go with a variable? Well, because variable, historically, will save you more money than a fixed. However, not always the case, depending on what point in history that you're in, and depending on what your financial situation is. Prime might not be right for you. As well, if you're someone who doesn't like to take risks, again, someone who likes to know what their payment is every month, variable's not the way to go. Reason people do take it, though, is variable tends to be a lot lower than fixed. So to give you an idea of the spread right now, Prime today is 2.25 minus 0.65. You're looking at, what is that, 1.6% compared to a 5-year fixed, which is 4.35. It's a big, big difference. So depending on what works for you based on your specific situation, I can make a recommendation for you, or you can watch some of my other videos and make a recommendation for yourself. But if you have any questions about fixed or variable or any other lingo that I throw around, feel welcome to give me a call. Leah Koss with the Mortgage Center.